Welcome to The Explainer. Today, we're tackling smart beta. It's pitched as this perfect sweet spot in investing. Smarter than just passively tracking the market, but way cheaper than a traditional active manager. But does it really live up to all that hype? Let's dive in and see what's really going on.
So what even is smart beta? Well, at its core, it's all about building an index in a different way. Instead of just giving the biggest companies the most weight, which is the traditional approach, smart beta tries to break the link with price. The whole idea is that a company's size isn't always the best measure of its future potential.
And this creates this really interesting hybrid strategy. It's not quite passive, but it's not fully active either. So where does it actually fit in the grand scheme of things?
This table really lays it out perfectly. On one side, you've got your classic passive investing. Super low cost, you know exactly what you own, and you're just trying to match the market. On the complete other side is traditional active management. It's expensive, often a bit of a black box, and the whole point is to beat the market. And right there in the middle, that's smart beta. It kind of takes the best of both worlds. It uses the clear, rules-based system from passive investing, but it has the goal of outperformance, just like active investing.
Okay, so if these strategies aren't weighting companies by their size, what are they using instead? Well, the answer is something called factors, and these are the real engines driving the whole approach.
Just think of factors as specific, measurable traits of a company's stock. Academics have found hundreds of them, but the industry has really zeroed in on a few key ones that have a long track record. So smart beta is basically just a systematic bet that these characteristics will continue to be rewarded over the long run. And here are the big five you'll hear about all the time. You've got value. That's just buying stocks that look cheap compared to their business fundamentals. Then there's momentum, which is basically betting that winners will keep winning. Quality focuses on really financially healthy companies. Low volatility, as the name suggests, targets stocks that don't bounce around as much. And size is a bet on smaller companies. Each one is a totally distinct bet on what drives returns.
A really simple way to think about these is to group them by how they act. Value and size, those are often your offensive players. They tend to do really well when the economy's booming. On the flip side, quality and low volatility are defensive. Their goal is to protect you a bit more when things get rocky. And then momentum. Well, it's kind of in a league of its own, just trying to ride whatever the current market trend is.
All right, so the theory sounds pretty solid, right? And when you look at the historical data, wow, the promise is incredibly tempting. It looks like a no-brainer.
And this chart is the heart of the sales pitch. This study looked at a 25-year period and, it found that these major factor strategies did in fact beat the plain old S&P 500. This is the kind of back-tested data that powers the entire smart beta marketing machine. But, and this is a huge but, that historical data comes with a pretty big catch.
You see, a lot of critics argue that the name itself is just brilliant marketing. The idea is that these aren't new concepts. They're old academic factors that have been known for decades. The innovation is just rebranding them, putting them in a slick new ETF package, and charging higher fees for it. So the argument is you're paying more for something that's just been repackaged.
And this is where the rubber really meets the road. While those historical backtests look amazing, the performance of actual live funds has often told a very different story. One really big study found that, on average, once these smart beta funds went live, they actually underperformed by about 1% per year. That historical promise just hasn't quite shown up in reality for a lot of investors.
So why the disconnect? Well, it turns out the fee on the label isn't the whole story. There are all these hidden costs. Because these funds have to rebalance to stick to their rules, you get higher trading costs. Their predictable trades can get front-run by faster traders. And as a factor gets really popular and crowded, it can push up prices and just kill future returns. All these little fins can seriously eat away at your gains. At the end of the day, the academic view is pretty clear. There's no free lunch here. You're just choosing from a different menu. That extra return you might get from, say, a value strategy isn't magic. It's thought to be your compensation for taking on a different kind of risk. For example, a lot of value stocks are companies that might be in some financial trouble. You're getting paid to take a bet on their comeback.
So with all these complexities, if you're still thinking, okay, I see the pros and cons, but I want to use this, how would you actually go about it? Let's look at a practical way you might fit this into a portfolio.
A really popular and frankly prudent way to do it is with what's called the core satellite approach. It's simple. You anchor the vast majority of your money, your core, in a super cheap diversified traditional index fund. Then with smaller satellite positions, you can use smart beta ETFs to tilt your portfolio toward a factor you believe in. Maybe you add a little extra quality for defense or a bit of value for that potential extra return, all without betting the whole farm on it.
Now, after all this talk about value, momentum, and quality, what if I told you that the success of your entire strategy might have nothing to do with the factor you choose? What if it comes down to something else entirely, something a lot more personal?
You see, there's this really frustrating phenomenon in investing called the investor returns gap. It's the difference between what a fund reports as its return and what the average investor in that fund actually earns. And why does this happen? Well, it's because we, as investors, tend to make some pretty bad timing decisions.
The gap is almost always caused by one simple thing: our own behavior. We chase what's hot. We see a factor that's had a great run, so we pile in, often right near the top. Then it inevitably goes through a long, tough period of underperformance, and we get frustrated and sell, often right at the bottom. Smart beta, with its really long cycles, can make this problem even worse. The key isn't timing the right factor, it's having the patience and the discipline to just stick with your choice for the long haul.
And this really leaves us with the final thought here. Smart beta offers this very compelling, systematic way to invest, but its success is absolutely not guaranteed. It demands that you make an active choice and then have the passive patience to see it through years of ups and downs. So when it comes to smart beta, maybe the most important factor of all is you.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.